welcome Andrey Movchan, who's joined us today, and my colleague, Alan McGregor, partner of AVC Advisory. Andrey is the chief executive of Movchan's group, along an illustrious career in finance in Russia and around the world is behind him, and no doubt well known to many of you who read the economic press about Russia. Andrey is an advisor to the Carnegie Group, and we're very pleased to welcome you today, Andrey. Thank you.
Thank you, Michael.
As you know, from the notes we sent, we're focusing on the impact of COVID-19 on on markets recently. Could you tell us, in your own words, your opinion on firstly the market downturn, and has that been solely the responsibility of COVID-19, or are other factors at play?
I wouldn't blame the virus. But the virus is not that smart to attack the markets. The virus attacks lungs, the blood systems, and other parts of the human body. And if you go back in the history for, is it 50 years to 1968? We had a major pandemics of the avian flu. It was called the Hong Kong flu at that time. Mm-hmm. About 4 million people were victims of the pandemics, and about 700 million people were infected, and the economics didn't react. It essentially teaches us that economics usually does not react to the infections. What economics reacts to is the administrative actions taken. And the administrative actions taken might be because of the infection or because of other things. And early March this year, the majority of countries took economic measures, administrative economic measures, but were preventing economics from functioning in a normal way. And it makes little sense to repeat all we know, what's done, how the quarantines work, and how it disrupted the normal chain of events in the economy. We know that the magnitude of the quarantines was as big that we saw America going down about 15% month to month in terms of GDP. Mm-hmm. And other countries, they pretty much followed the pattern. Some of them were fewer, some of them were more. China was about 13-14% month to month GDP drop. And we have the figures for the first quarter. We don't have the figures for the second quarter yet. But the figures for the first quarter, they are generally being received by multiplying 15% for the fraction of the quarantines in a quarter. So it may be like minus 3.5 in America because the quarantine lasted for about 1 month. It may be minus 7 in China because it lasted for 2 months, but it's pretty much the same in different countries. Which essentially shows the homogeneousness of the economy around the world in nowadays. Then closer to the end of April, 2 major things occurred. First, the society decided that they no more fear of the virus, but they fear about the economy. They are afraid of the economic collapse rather than of their lives collapse. And because of that, the government started to think of how to release the economy from the quarantines, and how to make the quarantines milder, and how to get economy back on track, make economy great again. Mm-hmm. And eventually what we see now is the transitional process from the fear of the virus to the fear of the economy. We know that many governments and many societies called what happened the first wave. We see that quarantines worked in many countries, better or worse, they did work. They decreased the number of people being infected every day. They gave the opportunity to the medical system, to the healthcare systems to adapt. And we see that the death rate goes down because the medical systems adapted to the virus, and they started to help more people. And then we now see the releases and the quarantines being lifted. And many countries already feel the second wave coming.
Mm-hmm.
Because virus doesn't know anything about our quarantines. It's not afraid of them. It works its way. And if we release people and people start interacting, the infection will grow. And it now started to grow. The major question now is, what happens with economies?
Mm-hmm.
If we do nothing with the economy, so we just release everybody and say, people, you're free to die, go forward to work. And in Moscow, you can see the crowds are already there. Mm-hmm. People are free to die and they want to die. They want to go into the offices, into the factories. They want to communicate. They want to sit in the restaurants, and they don't care about their health generally. The economy would probably recover because of that. Because anyway, even if the virus goes all the way down to the herd immunity, it'll take not more than 2-3% of people with that, and mostly the elderly people, the senior adults who do not work anyway. So the economy would go unhurt. Then it means we passed the worst point and the economy will recover. The speed of the recovery we see looking at China, pretty much the drop down was 15% month to month, and in most hurt areas it was like 50% to 70%. And
Mm-hmm.
these most hurt areas, they recover about 10 to 15% a month. So that's pretty much the pace we would see in the economy if we do nothing about virus. Then when virus comes back and more and more people get infected and the death toll begins to rise again, we'll see what the governments do. And maybe the governments will close the economy again, and maybe the governments will close the local places and spots with the virus. Maybe the governments will stick to the efficient Tetris strategy. It's something which is recently formulated by the Americans. Tetris means test, trace, and isolate. And we don't know to what extent they're going to be successful in that. And because of that, we can say little about the future of the economy in this year. We know that aircrafts would probably not fly with the density it was before. We know that offices would not be occupied with the density it was before. We know that the production of individual services would suffer for quite a lot of time because it's not recovering in China that fast. But all in all, generally, the economy would get back unless interrupted again by the official measures, by the administrative measures. And that's all I can say, because I don't know the future and I know the measures to come.
Andrey, I was just going to say, Mike, that given that we've had 10 years of a bull run, basically, and there was, starting to be some questions about the strength of the economy going forward. China trade war with the US was very much on the agenda October, November, December, before we forgot about it because of the virus. Do you think the markets were kind of primed for a downturn anyway?
Well, first, I don't know. And if I knew, I would have been much more wealthy than I am. And because I know how wealthy people made their fortune, I'm pretty much sure that nobody knows. We cannot forecast the markets. We can say the markets have certain probability of going up or down, but it's all around 50% all the time. It may be 70-30 or 30-70, not more. As of today, the risk premium in equity markets is quite high because the prime rates went dramatically down and the short-term end of the curve is down and controlled by the Federal Reserve System. We have the risk rates, the premium rates at the level of about 4, which is kind of a middle of the range. The markets can go either up or down with such premiums, and they've done that many times in the past. And the range for 3 years return historically from these points of the risk premium is from -20% to about plus 25%. Annualized. It's very wide. Given that, I wouldn't say that the markets are overbought. That's not true. On the other hand, we have many companies with huge Ps, and we have many companies which are doomed to suffer of the coronavirus crisis. And these companies are not entirely revalued to their proper adjusted values as of today. So I would be accurate with the index investing, because indexes may suffer because of that. What I would do, probably I would try to do cherry picking, because now with the volatility in place, there are many more opportunities in the market with shares which seem to be undervalued because of the overestimation of the crisis and because people just didn't fancy the shares lately. On the other hand, we have many other opportunities. For example, because of the increased volatility, we can sell puts. If we like a share but don't like the price, go sell puts, like 20% down. You get 10, 15, 20% annualized return on the premiums. And then if markets go down, you just get a good share at a good price.
My question was that before the call started, before the recording started, we talked about your new equity fund. And you've actually already mentioned the airlines and offices. You know, there's going to be some dislocation. There's going to be some not going back to the old ways. So it's the new normal, as people like to say. Maybe talk a little bit about where your new fund is targeting this kind of cherry picking that you've just mentioned, and what things are irretrievably gone forever, and what things will carry on as if nothing happened. Maybe you can say and how that affects your cherry picking strategy in the fund.
Well, frankly, it's a very complicated question. Not because it's hard to answer, but because it's probably a long time to answer. In few words, we don't believe anything is gone forever or anything really revolutionary new comes because of such pandemics. It's artificial for the economy. It's not the natural event for the economy. It doesn't reflect the stage of the economy development. And the economy most probably will get out of the crisis in exactly the same shape it was before the crisis. And imagine tomorrow we have an efficient vaccine, right? And we can vaccinate the population of the world. Why the economy should change? We vaccinate people in a month the virus is gone. We'll pretty much do the same we did. We may falsely believe that the trends we've had for quite a while, and the trends which we see more clearly now because of the virus are the new trends, but that's not. The online shoppings, the online conferences and cooperation and collaboration, the clouds and the social networks and whatever. It's all not new. We have it for long, and companies which provide us with the services, they can flourish now because of the moment in time, but then they can be overvalued pretty easily. And Zoom we use now, or do we use Zoom now, right? We use Zoom now. It's a great company for the moment, and many people made money on that. But what happens in a year time when people get back to offices, or many competitors of Zoom appear on screen, right? Zoom may go down 50% because it's dramatically overvalued as of today. Given that, we rather look at what are the long-term trends. But for example, we know that automotives are not fancy for many years. People do not like automotives. Automotives yield to S&P. We most probably would not buy automotives. At the same time, technology companies, good technology companies, are not overvalued in terms of their Ps and all other coefficients. And they grow because technology is not hurt by the virus. Big pharma is growing. The small pharma, on the other hand, is very risky because ups and downs in small pharmas are very huge. The online shoppings, the segment is growing. The education, certain things are growing, and we like certain things on there. And then semiconductors. The more we go, the more semiconductors are in need. And whatever war occurs between America and China, the semiconductors producers, they would just produce more because there would be two centers of the technologies, two different technologies two different sets of species of semiconductors and whatever. So this kind of things. And then we try to read through the local markets. Like for example, we like Korean market, and we like the Hong Kong market. We look at Swedish market. The Swedish market was one of the best performers historically, and now it's pretty much overvalued. But over time, it will come back to its pace, and we probably will see it performing as it did, and many other things. And we apply many filters, and we after we get the results, the short lists, we apply the thought. We look at the companies and we try to understand the positioning of the companies and why it still has the potential, and what are the risks, and why we believe the company will be revalued by the market. Because we don't believe that the markets will find out what we found out later. We need to read the markets before they do their assumptions. Not feeding the market with our thoughts, but vice versa, getting what the markets would think. Eventually, I'm not sure we're gonna be right 100% of the cases, and even 50% of the cases. We have good experience. We have pretty much good track record, and we'll try, but no promises.
Although the virus comes as an exogenous shock, so and the economic reaction is the reaction of governments and people. We have a saying in England, necessity is the mother of invention, and so a lot of things will go back to normal, but some things, it seems, will change. Maybe how we use office space, for example, might be one of those things. Do you have any particular feeling in your mind as to what has been accelerated as a result of this, and what changes that have taken place won't be reversed?
Well, I can fantasize, right? And now we can say whatever, because nobody's to check us, right? And
let's
we don't know what happens. Yeah, pretty much obvious thing is that office space would be more compact. Not many people, not that many people would need office spaces. Specifically in the megapolises and in big cities where people suffer going to work and from work back. And that would change, maybe not that fast, because everybody has contracts and big offices stay, and the economy has its inertia. But over time, it definitely will change, and maybe the coronavirus would become a small trigger on that way, fostering that and enhancing the process. People would think now about changing their demands with regards to the premises. And the less premises we need, and the more we want to work online, the more demand would be put on the systems. We need systems for online control of employees, for exchange of information, for exchange of data, for communication. We need to see each other. We need to see the gestures. We need to see the figures. We need to exchange emotions, and these will go into the networks. So most probably the business applications would turn from the focus on storing data to the focus of communicating data. The education, I think here maybe paradoxically, I think the trend would be the reverse. What I see now from the evidences what people share with me, they now start to understand that the online education is an impaired form of the education. I've spoken about that for many years, and I was actually taught in the University of Chicago, where I got my graduate degree, that education is not about knowledge. That education is about networking, cooperation, ability to collectively solve problems, the interaction with people who know and who can teach you how. And knowledge can be acquired from books, from from online courses, from whatever. But not many people understood that well. And now when schools started to work online, many people started to understand that schools are not about teaching subjects. Schools are about social networking of kids, about the growing up with adults who teach them, about the authorities, about networking, about the ability to cooperate and produce results and whatever. And it's very hard to achieve via Zooms. And in education, I think we'll see the split between the knowledge-based programs, which will go away from the universities, from schools, into the online courses, into the short-term courses, into the Coursera-based kind of things. And education, as we see it, the cooperation, networking, exchange of experience, which will stay with the universities and schools. And what I've heard from my boys' school already, that they might switch to like 3-4 days at school, 2 or 3 days home a week, because they're gonna split the knowledge acquisition and the experience and networking skills acquisition. And maybe we're gonna go into such a shorter week of presence, and networking / experience, opinions, collective skills, collective action skills acquisition would be segregated and compressed into kind of 1, 2, 3 days a week. And then people will have more of kind of library days for actual education, as we understood it in Russia and mainly in Soviet Union. Soviet Union, people disregard the skills for the fundamental knowledges. So that's another story. The third story, which may be kind of a subsequent to the officer story, people will try to move away from the epicenters of the cities. 10 years before, 20 years before, people like you tried to move to the very centers, to be 5 minutes walk from the office, to work there, essentially disregarding the climate things, disregarding the density of the population, the air, the pollution levels, the noise, even the price of the premises. Now I would forecast people moving, spreading around, going to countryside more, not willing to come back to the centers of the cities. It's a much more healthy move, but for real estate, it's a dramatic change.
Yes. Yeah.
No, well, another thing, maybe to end up with, another thing which we talk about in Russia now is that the authorities eventually found another good business to do. The one before was defense. You could spend as much as you want on defense, and people will approve it, because defense is defense. You need to protect the country from the enemy. And now there's healthcare, and the enemy attacks through the healthcare channels. And now you can spend as much as you want on healthcare. Nobody will blame you. Nobody will say it's too much, because the virus is attacked. And you have a window of a few years, maybe 5-10 years, before everybody understands that virus attacks are very rare. And this window is for spendings, and you can pour money into these directions. And even if the market in defense industry is pretty much shared, and everybody's taking the place, and it's deep red ocean. The healthcare market is not that red, specifically in the developing countries like Russia. And you can enter the market and offer the authorities a good contract, a good bargain, maybe good kickbacks, and get an oligarch.
To get through this to where we are, central bank intervention and state intervention have been enormous. Do you think the central bank and state intervention was necessary in the way it's been undertaken, or could less have been done, or could things have been done differently?
What we see that the intervention in America in GDP terms was about 4 times bigger than the intervention in Russia. surprisingly enough, the share of small and medium enterprises in Russia is exactly 4 times less than in America. So it pretty much corresponds one to each other. And given the fact that America is, in good sense of that word, a populist country, you need to prove you're a credible politician to be elected, unlike Russia, right? I would have expected the ratio to be even worse. Because Russian politicians are pretty greedy and they don't like to spend money. And most probably they spend pretty much as little as possible. I wouldn't say that American politicians did an excessive spending. But that's very vague, and I cannot say anything more concrete.
Yes. But accepting that we can only be vague generally, does this level of government intervention, central bank spending, lead to inflation on the one hand, and also does debt matter anymore? Does government debt matter anymore? Can governments borrow ad infinitum, or at what point does something change that means the cycle has got to come down the curve at the other end?
Again, it's a very complicated question. We talk about the very multifactorial system from which the economists know not more than half of the factors. And there are also sociologists and the politicians, and quarter of the factors is just unknown because we don't know the future. We can talk about today. There is no inflation today in America. The financial situation in America is extremely stable. No menaces, no hidden menaces in the system. The situation with the debt is pretty much manageable. As of today, again, we don't know what happens tomorrow. And what essentially happened in America, right? When I explained to my kids, I used the analogy with our own recent history. When the quarantines were imposed, we had a good big freezer with frozen food on our dacha. It's 70 kilometers away from our home in Moscow. But because of quarantines and this process and inability to move back and forth, we've left it all in dacha. We went back to Moscow premises and stayed for a month in Moscow premises. And we had to buy the whole new big freezer of food because we were afraid that the shops would not work properly. So we've made the storage. So generally, totally, we had 2 big freezers of food. We barely needed so much of food, but we had it, and there was not an excess because we ate what we had here in Moscow, not in dacha. And in about a month and a half, the fear disappeared, the passes disappeared, they vanished. We got the right to go to dacha there and back and forth again. By that time, we ate quite a lot of the food in Moscow. Then we went to dacha. We just started to eat the reserves in dacha. Nothing was wasted. That's pretty much what happens with the American monetary system, because so much money was frozen in the system because people just did not pay because they didn't consume because of the quarantines. They needed to substitute money with a new money. What happened with monies which were not used at the moment? Did they cause the inflation? No, because they were not used in the real market. But because they sit in the deposits in the banks mainly, they were used for buying assets in the financial markets. Financial markets soared because of that. What's going to happen when everybody's free and people start making their haircuts and going to restaurants and flying and whatever? First, they're going to use the new money in the system, and the inflation would start to grow. Once the inflation starts to grow, the central banks would sell assets back to the public and raise the interest rates. Once they sell assets and raise the interest rates, people will start to get money from the investments to the consumption unit. And the monetary aggregate will go down. And in an ideal world, it would go harmless and with no consequences. The problem is that the world is not ideal, and we don't know whether the Federal Reserve System would work good, excellent, or so-so, or bad. We don't know. There were sound examples of Federal Reserve System failing to provide good care about the financial markets. It happened in 2008. It happened in 1998. It happened in 1991, and whatever. Last times they worked quite well. If they do the same next time, everything would go smoothly.
So, which by going smoothly, you mean the potential to sell assets back and to potentially raise interest rates and not see a shock as a result, and not see a collapse in equity prices or a sharp decline in equity prices at that point? Or is that too much to hope for?
No, well, I wouldn't talk primarily about equity prices. The equity prices are not the excess pool of the economy. We need the household incomes. We need the supply and demand. We need the GDP growing. And again, the growth of GDP is not something which is sacred. We need certain parts of GDP to grow, right? We need the government to be able to pay its debts and to pay its bills. And then if equity goes down 20-25%, it happens all the time. Every like 5 years, right? And because the interest rates would grow potentially, and because the assets would be sold to the market, and because the leverage would go down, people would get away from equities, and they would go into whatever assets provide them with the security at that time. And we may see the equities go down, and 25% is not a big deal, right? We can survive that.
That'd be interesting when our recording is being viewed by, well, we told you that our audience is likely to be clients, and clients are often equity investors. They may not relish the idea of a 25% reduction in equity prices at the time, but
no, what I mean,
I take the point there.
I don't mean I'm anticipating and desperately waiting for the reduction in equity prices.
No.
I mean that when Federal Reserve System would assess the consequences, the reduction in equity prices would not be the prime thing. They would look at the household incomes, the jobless claims, the unemployment, the state of the real economy, the inflation, whatever, the debt, the budget, and if they need to pay with the equity prices for everything else, we probably would go for that.
Andrey, thank you very much.